What has been left behind?
Yeah, what we've seen this year is, of course, that really narrow leadership within tech. And what you've seen is that there's been laggards in economically sensitive parts of the market. So things like energy, industrials to start the year. But really, since June, you've started to see some of those areas perk up as economic data continue to come in better than expected. So if we are to see this more resilient economic data, we would expect broader participation in the equity rally, meaning that those areas that are cyclically sensitive should start to do better. And it also is important to point out that these are the areas that have seen the least amount of PE expansion or multiple expansion. So there's more room for those multiples to adjust to a better economic reality compared to the technology stocks and growth stocks that have already re-rated back up to their 2021 peaks.
As you indicated, the economic data has improved. Cameron, any evidence that earnings estimates have gone along with it?
This has been really peculiar this quarter, is that we continue to see economic data come in better than expected. We see it with economic surprises. We see companies beat and raise estimates. And yet, if you look at the full year estimate for 2023 earnings, they have inched down just slightly, which means that analysts are effectively cutting numbers for the back half of the year. So that does create a scenario where we have a low bar for earnings in the back half of 2023. But then we'd note is that what that also creates is even more growth expected in 2024. You have about 11-12% growth already baked in for 2024. And a lot of that is margin expansion, which would bring you back to peak margins back that we saw back in 2021. So that's one area where we would watch that maybe estimates are a little bit too high. But in the near term, it does seem that estimates are too low for the economic reality.
I remember a note that you put out in the last couple of weeks, and it was bull, bear, or duck. For the people that haven't read that, haven't heard you talk about it, what is a duck?
A duck is a market that goes sideways, but there's a lot of activity happening under the surface, meaning that if we do see this rotation away from some of the leaders this year, this idea that maybe tech digests some of its recent gains as it hits that peak in valuation, but you do see a recovery in some of these areas that have been left behind, those rotations under the surface could mean that there's lots of opportunity for price changes, but the overall index doesn't move very far, just meaning that we've kind of hit a ceiling on broader valuation, but there's still lots of room for rotation underneath, which is one of the ways that we've been playing this market since the beginning of June, buying equal weight, looking for areas that are trading at discounts in order to take advantage of the rotation. So a duck market seems smooth on the surface, but lots of activity underneath.